Every December, billions of dollars in stocks get sold. Not because anything changed about those companies, not because earnings collapsed, not because the market's panicking. They get sold because of a calendar date. December 31st. The IRS fiscal year deadline triggers one of the most predictable mass liquidation events in financial markets. And the stocks that get dumped aren't chosen by fundamentals. They're chosen by math. Specifically, by which ones lost the most money that year. This is the December effect, a system-level exploit built into the tax code that reshapes portfolios, distorts prices, and creates a short-term reality where a stock's year-end performance has almost nothing to do with the company behind it. Let's break down the actual mechanics, because the surface-level explanation you've probably heard, sell losers, save on taxes, skips the architecture that makes this interesting. Tax loss harvesting works like this. If you hold an asset in a taxable brokerage account and it's worth less than what you paid for it, you can sell that asset and claim the loss. That realized loss offsets your realized gains from other investments. If your losses exceed your gains, you can deduct up to $3,000 against ordinary income and carry forward anything left over into future tax years indefinitely. On paper, it sounds modest, $3,000, but that's just the floor. The real power comes from offsetting gains. And in a bull market, there are a lot of gains to offset. In 2025, one single asset management firm, Parametric, harvested over $8.8 billion in losses across its client portfolios, generating an estimated $3.3 billion in potential tax savings. That's one firm. Now multiply that across every robo-advisor, every wealth manager, every self-directed investor running the same playbook, and you start to see the scale of what's happening every November and December. Here's where the system design gets clever, and where most people stop paying attention. When you sell a losing position, the IRS doesn't care why you sold it. It doesn't track your intention, but it does have one rule designed to prevent the most obvious exploit: the wash sale rule. You cannot sell a security at a loss and repurchase a substantially identical security within 30 days, either before or after the sale. That's a 60-day window total. If you violate it, the loss gets disallowed. Simple enough constraint, but substantially identical is doing a lot of heavy lifting in that sentence, and the ambiguity is where the metagame lives. Selling an S&P 500 index fund at a loss and immediately buying a different S&P 500 index fund from another provider? The IRS hasn't definitively ruled that as a wash sale, even though the economic exposure is nearly identical. Selling individual tech stocks at a loss and rotating into a tech sector ETF. Same concept. You've harvested the tax benefit while maintaining almost the same market position. It's like resetting a cooldown timer. You haven't left the game, you've just refreshed your ability to use a specific mechanic. This creates a cascade. As millions of investors execute these trades simultaneously in the final weeks of December, the stocks they're selling experience artificial downward pressure. Not because the market has reevaluated their worth, not because new information emerged, because the tax code created an incentive to sell them at that specific time. And the stocks receiving inflows, the replacement securities that maintain similar exposure without triggering wash sales, get a corresponding artificial boost. So you end up with a temporary distortion layer sitting on top of fundamental pricing, driven entirely by fiscal calendar mechanics. Now here's the part that turns a tax strategy into a market-wide phenomenon. This isn't just retail investors clipping $3,000 off their tax bill. Institutional investors engage in a parallel version called window dressing. Fund managers sell their worst-performing holdings before year-end, so those positions don't appear on their annual reports. Nobody wants to explain to clients why they held a stock that dropped 40%, so the losing positions get purged. Not because the thesis changed, but because the optics changed. The incentive structure is different from tax loss harvesting, but the market impact is identical. Concentrated selling pressure on the year's biggest losers in the final weeks of December. Between tax loss harvesting, window dressing, and portfolio rebalancing, where investors sell winners and buy losers to restore target allocations, December becomes a month where price movements are driven less by fundamentals and more by structural incentives. The market is still processing information, but it's also processing a wave of trades that have nothing to do with information at all. This structural selling is what feeds the so-called January effect. First documented by investment banker Sidney Wachtel in the 1940s, the pattern was straightforward. Stocks, particularly small caps, tended to outperform in January relative to other months. And for decades, the data supported it. Between 1925 and 1980, small-cap stocks outperformed large caps by an average of 4.6% in January. The S&P 500's average January return through 1993 was 1.85%, the strongest month of the year. The explanation was mechanical. Stocks artificially depressed by December's tax-driven selling rebounded as that pressure lifted, new capital entered the market from year-end bonuses, and investors repurchased positions once the 30-day wash sale window expired. But here's the reveal, and it's the part that makes this story about more than just seasonal trivia. The January effect has been decaying for decades. In the 30-year period through 2023, the S&P 500's average January return dropped to just 0.28%, from the best-performing month to the 8th. Small-cap stocks, which used to surge over 4%, actually showed a slight average loss in January over the same period. The pattern that once generated reliable alpha has been largely arbitraged away, and the reason it decayed tells you something fundamental about how markets evolve. Once enough participants recognize a predictable pattern, they front-run it. Algorithms now account for roughly 65% of January small-cap transactions, compared to about 15% in the 1980s. Robo-advisors harvest losses systematically throughout the year, not just in December, smoothing out what used to be a concentrated seasonal spike. Tax-sheltered accounts, 401ks, IRAs, shelter more capital from tax-driven trading than they did 40 years ago, reducing the pool of assets subject to year-end harvesting pressure. The exploit still exists. It just yields diminishing returns as more players run the same strategy. This is a pattern you see across every complex system: financial, competitive, digital. The moment an edge becomes common knowledge, the system adapts. The meta shifts. The alpha fades. What was once a reliable cheat code becomes standard play, and the advantage migrates to whoever finds the next layer. So what's the current state of the game? Tax loss harvesting itself remains a genuinely useful optimization for taxable accounts. The math is clean. If you can defer taxes by realizing losses today and letting gains compound longer, you come out ahead over time, assuming you reinvest the tax savings. For high-income investors using direct indexing, where you hold individual stocks instead of index funds to harvest losses at the single stock level, the potential savings scale significantly. On a $2 million portfolio, harvested losses can range from $100,000 to $400,000 depending on market conditions. That's real money, not theoretical. But the market-level effect, the idea that you can reliably buy December's losers and profit from a January rebound, has been competed away for most participants. The edge migrated from buy small caps in January to use automated systems to harvest losses continuously throughout the year. It migrated from calendar timing to infrastructure. The investors who benefit most from tax loss harvesting today aren't the ones watching the calendar. They're the ones whose systems are watching every position, every day, executing when the math favors it regardless of what month it is. And yet, December still moves differently. Not because of one big effect, but because of the convergence of multiple structural forces: tax harvesting, window dressing, rebalancing, options expiration, reduced liquidity during holidays, all compressing into the same few weeks. The result is a market that's temporarily less about value and more about plumbing. Prices during this window carry noise that doesn't exist in March or July. And that noise creates opportunity for anyone who can distinguish between a company in genuine decline and one that's simply been caught in the year-end liquidation wash. That distinction between signal and structural noise is one of the most useful filters in investing, and it applies far beyond December. If this kind of systems-level breakdown changes how you think about what's actually moving prices, subscribe to 8-Bit Economics. Every week, we strip complex financial systems down to their core mechanics. No hype, no predictions, just the underlying code that runs the machine. Hit subscribe, drop your take in the comments, and like the video if it shifted your perspective even slightly. By the time everyone sees it coming, the smart play is already over. Here's what sits underneath all of this. Markets are supposed to be pricing mechanisms, elegant systems for aggregating information about value, and most of the time, they are. But every year, for about 6 weeks, A significant portion of market activity is driven not by information about value, but by the structure of the tax code, the incentive design of fund management, and the mechanics of calendar-based accounting. The prices are still real, the trades still settle, but the signal-to-noise ratio shifts, and if you don't understand why, you're reading the output of the system without understanding the inputs. Every complex system has these structural rhythms, moments where the rules of the game temporarily override the substance of what's being played. Understanding when that's happening doesn't give you an edge. It gives you something more useful. It keeps you from confusing the calendar for the market.